So I want to ask you on your take about the upcoming earnings season and if there's certain strategies that we can use to take advantage of the amplified volatility. I know some of the most common strategies are buying straddle, strangle and selling iron condor, iron butterfly. And I'm curious on what you think of those strategies from the perspective of risk management and portfolio optimization. So yes, typically, and apologies, you probably have to have a little bit of experience with this, but the typical earnings trade that people out there will teach you is essentially because we know that volatility tends to go upwards as you approach unknown events. So an earnings report, for example, volatility will steadily rise into that event. And then after the event, after the announcement comes out, typically good or bad, because now there's no more mystery, volatility will crush down. So what a lot of people will tell you to do is maybe a day or two before the earnings comes out, you're going to sell that high volatility. You're going to wait till the announcement comes out. Vol crush is going to happen and your trade's going to benefit. So if you have a short straddle or a short iron condor, earnings comes out, volatility comes down, and you make a bunch of money. The problem is big price movements can be even more punishing than the benefit of that vol crush. So what ends up happening is you get a lot of easy wins. And then once in a while, you get an earnings event that is catastrophic. A price move shocks way past your endpoints and you lose a lot of money and you end up giving back a lot of those easy wins. So you could have 6 or 7 that work out perfectly and you think, wow, this is the easiest thing in the world. And then you'll get one that just crushes past your stops and you've given it all back. So what I do is I actually flip that opposite. Basically, there's nothing that's really predictable other than volatility tends to rise towards unknown events. So we can use that to our advantage and say 2 weeks before the earnings announcement, we can get into a long volatility position. So a long straddle, for example. And because we're expecting volatility to at least stay the same, but probably rise into the announcement, that volatility trade shouldn't bleed too much of the theta. It should actually stay fairly consistent. And then what you want to do, of course, because we know as soon as earnings comes out, it's going to crush, you actually close your trade the day before earnings come out or the day of, like if it's an aftermarket earnings call. And doing that, you're basically hoping for some price movement in that 2-week period. So that's what I would say right now. And what you're really looking for with earnings trades, if you do it my style, which is definitely rare. I mean, this is sort of counter to what all these people who are selling you courses and they'll tell you to do. But remember, I'm about safety and risk management. I'm not trying to get, an 80% win rate and then look really good in front of my subscribers. I'm actually just trying to make the most amount of money. And what ends up happening with a high win rate, you're basically selling those tails and your delta is going to be occasionally much stronger than your vega and it's going to hurt badly. So I'm just interested in what works best. Long straddles, long calendars, a week or two before earnings, that's the way to do it. The key component here is that you don't want to do it when volatility is high, of course, because that could actually bleed down. But right now, like I said, volatility is relatively low, all things considered. If you look at a 10-year horizon, the VIX is average or above average. But right now, recently, this is low. So we're heading into an earnings season. This is actually a reasonably good setup for my earnings strategies. And I'm glad you brought this up. I'm actually going to be hitting this earnings season pretty hard as of now. I mean, the market could change. Something cataclysmic happens over the weekend. And then maybe on Tuesday, the VIX is up at 30. Well, I wouldn't be buying long straddles at that point anymore. But as of right now, this market is set up quite nicely for long straddles. So that's what I would be doing. I would be sort of utilizing my own style that I have built up and tested for 15 years. And I know that it works much, much better than the common strategies, like you said, selling, strangle, straddles. No, you don't want to do that. You're introducing way too much portfolio risk when you do that. There's far too many people that think that high win rate is what you're chasing, but you got to remember that even a 95% win rate could lose money long term. If the 5% of the time you lose big. That tends to be what happens when people sell the out of the money tails. They think they're a genius trader because they had 15 winning trades in a row and then one losing trade just tanks the whole thing. So I much prefer to use that expected rise in volatility in our favor.